Hello everyone. Let's wait for a minute for others to join. ZX, can you confirm whether my screen is visible and voice is audible?
Yes, it is.
Okay. All right, let's get started. So, hello everyone. Very happy to host the ninth AMA. And that while the team was working hard for the phase 2 launch, which is scheduled on September 19th, we are here. Thought of start the discussions about assurance NFTs with the community. Since it's just 1 week for the phase 2 launch and one more month for the phase 3 launch, so it'll be good to start discussions around assurance NFT with the community. So here we are today. We'll be discussing the comparisons between Pana and other insurance protocols which are already there. So yeah, let's get started. So to give a brief background on the insurance evolution, so it all started when it started with community driven. For example, some few people come together, around 100 people or 50 people come together. They pool in premiums. And then yeah, and then they expect what are the risks that are going to come in future. And if at all one person from the community gets affected by that particular risk, then the seniors or elders from that community will decide whether the pooled in amount can be given to that particular person to cover his or her loss. So that is how it started. In that case, the major advantage is that there will be out and out transparency, no transaction costs, since it is like within a community, within a closed community. So those benefits were there, but the issue is economy of scale. For a particular insurance to be successful, definitely the insurance can be successful only if large premiums are pulled in, diversification of people are there. So that is where carriers started appearing. So carriers started pulling in different people from different parts of the world. They started pulling in the premiums so that the economy of scale is achieved. And then what happens is they became the agents for the customers, and they started setting terms. And there is also a conflict of interest appearing because they are the revenue owners, and at the same time they are going to settle the claims, they are going to set the terms for the claims. So that is where some factor of distrust creeped in. So to tackle that, regulation and compliance, everything came inside. So if you see the white paper, I have attached a snapshot of white paper from various insurance protocols. So if you see that around 35 to 40% of the premiums that are paid are spent for the operational costs, regulatory expenses, operational expenses, and logistical expenses, intermediary expenses. So it is not. It is a fact that a large portion of the premiums that are paid for the insurance product is being spent on operational cost rather than for covering the risks. So this is where blockchain is the best platform to be leveraged for taking insurance forward. So moving forward, so I just wanted to stress on these three: capital and the risk coverage structure before getting into the other insurance protocols, because these will be repeating in the different insurance protocols, and also when we compare PANA and other insurance protocols, this will be a major point. So when you look at an insurance structure, capital structure, there are three things. First thing, we can call it as pure premium. Pure premium can be explained like, for example, in the previous case when we discussed the community model, what happens is 100 people come together, so they pool in the premium. They expect that certain risks will come. So if you put a value for that risk, it might come around some $100 or something. So if you divide that $100 between the community members, that will give you the pure premium. So the premium that needs to be paid by each and every member of the community, so that in future, if a particular risk has been there, then that will help cover the disaster. So that is pure premium. But usually in both traditional insurance and also in crypto insurance, the premium that actually the user pays will be way above than the pure premium. So what it includes is the pure premium, the operational cost, and the profit margin. So these three will be included in the premium. Now the third thing is backup capital. For example, previously we discussed that they'll discuss and they'll come to a conclusion that certain risks, the probability of a certain risk will be evaluated. So based on that, only pure premium will be decided and premium will be decided. But there is a chance that some unexpected risk can happen at the same time. So that is where there should be a backup capital to alleviate those risks that are happening without the expectations of the community. So this is where EIOPA Solvency II norms, that is directly from Europe. It states that 99.5% of the probability should be factored in. That is, one in a 200-year event should also be considered while we set aside the backup capital. So this is also important for an insurance protocol or an insurance industry to be viable in a long term. So these three things, just keep in mind. We'll come back to it while we discuss the comparison between other insurance protocols and panel. So this is the comparison between traditional insurance and PANA. This also will come back later after discussing the comparisons, so that we'll get a better sense of idea. So coming to our first insurance protocol that we are going to discuss today, it is Ensuro. So if you see the architecture here, it is like, first the liquidity providers will be the core who will be investing into the liquidity pool. So what happens is Ensure liquidity pool is actually bridging the risk models and the liquidity providers. So the liquidity providers will be investing huge amounts of money to the liquidity pool, and they'll accept to a cashback period. What is a cashback period is, they'll say that I can lock my funds for 1 month or so. So based on the lock-in period that they are accepting, they will get rewards. If they are accepting for a longer lock-in period, they will get more rewards, and if they are accepting for a lesser lock-in period, they will get lesser rewards. So that is the core of the liquidity providers. So they will provide the liquidity into the Ensure liquidity pool, And then what happens is on the left we have the risk model providers. So what happens is these are a set of contracts, smart contracts, wherein the risk model providers will start pulling in new risk models, and those risk models will be checked for the assurance, for the quality assurance by the insurer's quality assurance system. And then once it is approved by the liquidity pool will set aside certain funds from the liquidity pool to back this particular risk model. So once that is done, the risk model goes live, and the customers will be buying the risk cover from the risk model providers, and they in turn will be getting the ERC 721 NFTs. So if at all that risk has been uh, happening in the future, then they'll get their payback accordingly. If not, then the premium that they pay will go to the treasury of the insurer or liquidity pool. So this is the overall architecture. And in the middle, we also have one more thing called as yield bearing protocols. So out of the liquidity that is being provided by the liquidity providers to the liquidity pool, a certain portion will be set aside to be invested in the yield-bearing protocols, and that will give a risk-free interest to be set aside for paying the interest to the liquidity providers. So the main issue here is liquidity providers are investing in the liquidity pool. What they are doing is, one is they funds for a particular period. So they will not be able to use that funds as and when they require. The second thing is there is a risk involved. So if at all something goes wrong in the risk models that they're investing in, and there comes a situation when the customers will be reimbursed more than the premium pool. So the premium pool is what the customers are paying into the pool, and the SCR pool is the additional backup liquidity that the liquidity providers are providing. So if at all a case appears that huge risk has happened and the premium pool is not sufficient to pay back the users, then the SCR pool will be touched. If the SCR pool, what is SCR pool is solvency capital requirement. So if the SCR pool is touched, it means that the liquidity providers are losing their money. So this is a huge risk that the liquidity providers are taking here to get some sort of rewards. So this is Ensure protocol. We'll compare after looking at other protocols, and we'll compare it together. So this is Ensure. Moving forward, we'll get Etherisk. So Etherisk, this is actually a very interesting protocol. They are actually taking in very practical use cases like flight delay insurance or crop insurance or hurricane protection. So what they do is they actually build in a particular risk model. That risk model will be provided by the risk model providers. Then they'll be using data providers and oracles. For example, for this flight delay insurance, Etherisk has collaborated with uh, Chainlink Oracle to get the data from Flight Aware API. So what they do is they collaborate with such oracles, and then they get the data from that, and based on that data, the parametric insurance will be triggered, and the customers will be provided with the returns. So this is flight delay insurance, or crop insurance also the same. We'll have to put in the crop and the location of the particular field, and then the payouts will be triggered based on the data from the government agencies. So this is just straightforward practical use cases that Etherisk is building on. But again, there is one other issue over here. Sorry, two other issues are there. One is whatever premium that you are paying, it is going to be for an unpredictable event. For example, if you are paying for a flight delay insurance, only if the flight is delayed, you will get back the payout. Otherwise, what you paid as premium is gone. The second thing is there is a token called as risk pool token. So there is a token called as risk pool token. This is again to ensure that the solvency capital requirement is to be adhered to. So in this case, huge investors will invest huge money into the risk pools, and in turn, if something goes wrong, again they'll lose their money. So the investors are also at risk, and the customers, they are paying premium. They might or might not get the payout back. So these two are the issues with risk. Moving forward, we have Airball. This is again similar to Etherisk or the other protocols that we see. They are mainly into four areas: agriculture, energy, maritime, and hospitality. So they are developing particular specific products for agriculture, like whenever rainfall is getting reduced, or whenever flooding happens, or whenever energy loss has happened, something related to these four areas. I just wanted to show a particular interesting phenomenon that they have is, for example, if you consider rainfall precipitation based cover, you have the average precipitation is 4.83 and then you have the option like you'll have to pay $753 premium to get the payout if the average rain goes below 100%. If you need to get the payout when the average rain goes below 90%, you have to pay a lesser premium. So they provide you options for premium to set the parameters for the insurance that you wish to take. So this is also interesting and practical use case that they are leveraging upon. And again, they are going to use data oracles to pull in data to check the average precipitation for a particular area. So in this case, the same thing prevails. You pay a premium if this event, for example, you pay for below 100% of average rain, but for that particular year, the rain is above 100%. So then your premium is lost. So this is again like premiums are expenses and not investment. So moving forward, we come to an important protocol called as Nexus Mutual. So currently they are providing three covers. One is for yield token, the protocol, and the custodian wallets. So this is mainly for smart contract based cover. So if some bugs or some financial losses happens to the user because of the unintended use of the smart contracts or bug in the smart contract, then you will be covered for the losses that you incur on those particular protocols. So in this case, what they use is ERC20 token. And second important thing is they are using continuous token model. Here they use the term called as minimum capital requirement. For example, when users, for example, if a particular risk product is being developed and the users are buying the product, then they'll be pooling in the premium. What happens is when all the users are pooling in the premium into the capital pool, the cover will not be activated immediately. The cover will be activated only when the capital pool reaches the minimum capital requirement. Minimum capital requirement is the requirement of capital to back up the expected risks by the protocol. So till then, the cover will not be activated. Only after the capital pool reaches the MCR level, then the cover will be activated. And then after that, whenever the capital level goes below the MCR, the price of the token will be lesser, and if it goes above the MCR, the price of the token will be more based on the demand and supply. So the third thing is claims assessment. So this is where it is an important thing for Nexus Mutual because they are setting very detailed terms and conditions, and for the claims assessment to be done, there should be a claims assessment panel for users who are helping out the protocol for assessing the claims. They'll be provided rewards. And but what happens is there is a chance that there might be unintentional or malfied intention from the claims assessor to go in a wrong way to benefit a particular claimant. So in this case, they are having a phenomenon wherein the claims assessor should stake the Nexus Mutual token, and then they should get involved in the claims assessment process. So if there is some malintention that is seen in the claims assessment, their tokens will be burnt and that will not be returned to them. And also, next important thing is risk assessment rewards and staking. Again, risk assessment is a very important thing for Nexus Mutual because they are dealing with smart contract cover. So risk assessment should be for the assessors who are assessing the protocols or the smart contract codes for any bugs or any potential risks in future. So they'll also be rewarded appropriately. So this is about Nexus Mutual, and just wanted to put out an interesting thing about the claim assessment. If there is a panel in the claim assessment panel, and one member is voting with the consensus, then he'll be rewarded more. If he is against the consensus, then he'll be rewarded lesser. And if no consensus is achieved in the claims assessment panel, then it will be put out to all the members and it will be put out to vote. So this is a detailed claims assessment process that Nexus Mutual is practicing. But there are issues with the claims assessment because it is going to be difficult because there are minute caveats that are put in the terms and conditions that needs to be assessed, and there can be differences of opinion between different members, and there is a strong incentive to deny the claim if at all the protocol feels so. So there is a risks there, but they're practicing a very organized approach there. And related to funding model, again, they're also following the solvency to 99.5% probability model. So backup capital is being dedicated for that. And yeah, the product that they have started is smart contract cover with a fixed cover amount. So if a parametric event has happened or not, it is just an answer of yes or no. If yes, the payout will be paid. If no, the payout will not be paid. So it is not like assessing the level of damage and then paying out. It is just assessing whether the damage has happened or not. Yeah, just to put out some minor caveats, some interesting caveats that I found. Like if you see the first caveat, it is saying that before the cover period, if there was some public bug disclosure or warnings related to the event, then you will not be covered for that particular event. That is fair enough. But the second point is like they are saying if the designated protocol is a fork of a parent protocol, and there is a bug announcement from the parent protocol, again the claim will not be settled. So this is where it goes deeper and deeper, and there is a strong chance of the claims being denied. And another caveat that was shown was if there is some losses due to movements in the market price of the assets in that the protocol relies upon, again your claim will not be settled. Yeah, and there are some other. If you see the claim amount guidance, then it will be even more interesting that if the claim payments will be based upon the evidences. So you should, for example, if you are taking a custodian wallet cover, then you should prove that you have been impacted because of the custodian wallet issue. This will be upon you to prove and then get back the claim. So these are some very detailed and minor caveats that they have put in. So the claims assessment takes importance, and there is incentive to deny the claims as well. So these are some of the issues that we saw in different protocols. So this slide will come back again after explaining assurance NFT of Pana, so that we'll be able to easily compare and contrast. So as far as the assurance NFT in PANA is concerned, I'm not going to take you into the detailed architecture of the assurance NFT. We'll have a separate AMA to discuss the architectural blueprint, which the team is now working on. But I will just say the high level architecture of assurance NFT and compare and contrast that with other protocols. So this can be considered as an overview of PANA protocol. So if you consider, it can be divided into two sections. One is on the left and the one is on the right. So assurance NFT is on the right, and whatever we are doing right now, phase one, phase two, and phase three launches, those covers the launch of the master treasury. So as we have planned our second phase launch on September 19th, our master treasury contract will be deployed on that particular day. And what exactly is happening over here is you'll be able to get LP tokens from Pana USDC LP that is already live there, and you'll use the LP tokens to bond with the master treasury, and you'll get in turn Karsha. Karsha is the rebasing coin that keeps accruing value over time. So this is the primary bonding phenomenon that is happening in the master treasury. So it might be at the outset, if you see, it can be just considered as another Olympus fork, this particular master treasury section. But if you see, we are doing this exactly to support the assurance NFT phenomenon. As we were seeing earlier, that there was a requirement for backup capital or SCR, wherein the heavy investors were uh, investing in the pools and they were taking the risks to invest in those pools. But what we are trying to do is we are using this master treasury. The master treasury grows in size as and when the bonds are increasing in frequency. So the master treasury grows in size based on the profits out of the difference between the intrinsic value and the market price. So this profit and this increase in treasury size will be used as a backup capital if something goes wrong in the assurance NFT phenomenon. So this is going to support us for the further phases. So that is the significance of the master treasury. And if you come to the assurance NFT section, you can see that there will be different NFT collections. For example, NFT collection one can be said to be Mumbai floods, or NFT collection two can be for Chennai floods or earthquake somewhere in some part of the world. So there can be multiple NFT collections like this, and all these NFT collections are separate treasuries on its own, which we call it as disaggregated treasuries. So what happens is the user will come in with the stable coins. It will be mostly USDC. He'll again use the bonding phenomenon that we use in the master treasury, but the only difference is in the master treasury we use LP tokens and here we use USDC. So he'll bond with the USDC into the NFT collection treasury, and he'll in turn get ERC 1155. So this is the major difference between Pana and other protocols. We saw that ERC 721 or ERC 20 were used by other protocols, but what we are using is ERC 1155, mainly because of its ability to hold Karsha within it. I mean, like it can hold another ERC 20 within ERC 1155. So that is the major use case for us. So when the user gets ERC 1155, what it consists is equivalent amount of Karsha. For example, the user bonds 10 USDC into the NFT collection one. What he'll get is ERC 1155, and he'll get $10 worth of Karsha within the NFT. One is that. So this is going to be an outright investment for him. So without any parametric cover, if you just consider this, it is going to be an investment because he's going to get equivalent amount of Karsha, and also if you consider Karsha as a rebasing coin, and it keeps accruing value. So it is going to be investment on one hand. The second one is he's going to get sovereign ownership of the NFT, and he can use this NFT to trade in secondary marketplaces, NFT marketplaces. So he can use this to trade in the other marketplaces, and he can barter around that. So it is going to be another use for him. And third one is he is going to get the parametric cover, which is the important asset that he is going to get. So what he'll be getting is for the first 90 days he'll be locked, and he'll not have the parametric cover or the NFT ownership of the treasury. So after the first 90 days, his parametric insurance will be activated, and based on his particular share in the NFT collection treasury, he'll get the NFT ownership of the treasury. So this is when a particular parametric event happens, he can opt for the protocol to buy back this share and pay him accordingly. So these are the important benefits that he is going to get out of the NFT collection treasuries. And one more thing is he's going to pay in USDC, and that USDC will be invested in the yield bearing protocols like Curve or Compound, and that will help in increasing the yield for the protocol, and also that will help in paying the user with a multiplier in the future. So this is the basic architecture of the assurance NFTs that we'll be handling. And also one other important thing is we are getting in stable coins, so the volatility is also taken care of. So in future, if you're coming back again for a payback, then you'll be paid in equivalent amount of Karsha at that particular point in time as you are using a stable coin. So that is another advantage of the assurance NFT. Going forward, so this is just an overview of what happens. So when premium is paid, you will get equivalent amount of Karsha. That Karsha will be represented by the Pana token values, and 100% premium will be used to generate the claim value. This is like if you are paying $10 of USDC, you will get $10 worth of Karsha. But again, the your premium cover will be $10 and not anything less, since you are getting Karsha on the other hand. And then based on your premium that will be invested in the yield bearing protocols, so the yields generated from the premiums will be increasing the treasury size in the future. And third one is like this is also an important thing. For example, how we are planning to take assurance NFTs forward is there will be a window period within which you'll have to make the first premium payment into the NFT collection. So after the window period is over, thereafter the number of shares of the NFT collection will definitely keep declining till the expiration of the NFT collection. So if you see, there are four conditions. First condition is if someone make claims. So for example, if a parametric event happens and if someone wishes to wishes to cashback, then what happens is his NFT ownership of the treasury will be revoked, and that will be distributed across other holders. So the holders will be benefited, and at the same time, the user who is taking the parametric payout will also be benefited. The second one is loans. Yeah, I forgot to cover this. So as we saw in some other protocol that there will be an accepted cashback period. So for example, if investor is investing huge amounts into the liquidity pool, then he'll accept that for 1 month or so he'll be locked in. So he'll not be able to access the funds in that particular period. But what we are planning to develop is we'll have Karsha lending based on the ERC 1155. So you'll get the ERC 1155, and then you can use that to get Karsha loans, and immediately you can use that Karsha loans, and if you wish, you can even invest that in some other yield bearing protocols and increase your yield. But the only caveat there is during the period you take the loan and you repay back the loan, you will not be given the parametric cover during that period. If some parametric event occurs, you will not be able to opt for a buyback, but you can easily access the loans and you can use the funds whenever you want. So the syndicate participants have multiple advantages over there. One is they can invest how heavily they want. They can immediately take that through loans, and they can invest the Karsha in some other yield bearing protocols. That will be a double benefit for them. And also another thing is they will not lose the funds because of that SCR requirement. And the third thing is stop paying premiums. So as we know that assurance NFT is going to be premium based, so it is going to be month on month premium payment. So uh, you can pay as low as 1 rupee per month or even 1 cent per month, but you should be paying every month. So if a particular user takes a parametric cover and then he fails to pay for a particular month, then his parametric cover will be revoked, and he will not be giving access to the NFT treasury ownership. That will be revoked and that will be distributed among the other holders. But again, you'll not be at a disadvantage because you can use the Karsha that is there in the NFT, but you'll not be able to get the NFT ownership if some parametric event happens in the future. So that is going to be a mutual benefit for the holders and also for a person who is going to cash out. The final one is burning the NFTs to cash out early. This can happen like if you consider if you're paying a premium and then you're taking the Karsha, you're taking ERC 1155, and at some point in time after 1 month or so, you feel that Karsha price has skyrocketed. So you may be tempted to use the Karsha within the NFT to cash out. That is very much possible. In that case, if you wish to cash out the Karsha, then the NFTs will be burnt and the Karsha can be cashed out. So it will be benefit for you because of the skyrocketing price, but your NFT ownership will be revoked, and that NFT ownership will be distributed to the other holders of the protocol. So again, it is going to be the declining ownership over time. So, uh, so anyhow, after the window period is over, it will be the ownership will be declined, and the holders will be incentivized to hold. So this is the other important thing to be discussed. So this is the overall architecture of the assurance NFT. Now, if you come back to now if you come back to this slide, you'll be able to easily compare. The first point is premiums are expenses. So if you see in all the other protocols, whatever premium that you pay, that you can get the reap the benefits only if the event happens. Otherwise, your premiums are just expenses without any rewards or benefits. But as far as Pana is concerned, again, you are going to have the Karsha equivalent of the payment that you do, and that is going to be an investment. And if a parameter given happens, again you're going to get more benefits out of it. So premiums are not expenses with Pana protocol. The second point is claims can be denied. So if you see, there were some caveats and there are some incentives to deny the claims because because of the terms and conditions that are set out there. But as far as PANA is concerned, we have 2 points are there. One is we are not incentivized to deny the claims because anyhow we do not own the NFT collection treasury. The users own it. So it is going to be like if the expiration of that particular NFT collection is 1 year, at the end of the 1 year, whoever holds, if it is 3 or 4 people, then the revenue out there in that treasury will be distributed among those people, and the protocol will take a very small cut, 5% or something, that will decide later. So it is going to be we are not incentivized to deny. And the second thing is the claims will be the NFT collections will be designed in such a way that it will be very easy call to see whether the claim to be accepted or denied. And third is covered no incentive to hold. We saw that there are a lot of incentives to hold in Pana, and ensuring frequently occurring events. Again, it is going to be one other thing. We'll be incentivizing the user to hold, so that we'll take the NFT collections in a way that the parameter event should happen frequently rather than once in a year or so, so that the users will be incentivized to hold rather than cash out. And then small premiums, again we discussed. ERC 721 we discussed. And currency shock factor, again we are using USDC in the assurance NFT stablecoin, so volatility is also factored in there. And risk to investors and SCR we discussed. Accepted cash period also we discussed. So yeah, these are the major advantages that we think about assurance NFT, and we'll need your support to move forward whenever we start designing the NFT collections. Yeah, that's it from my side. Any questions?
You did a great job at that, Sarah. That was great.
Thank you, Zrika. Any questions outstanding in Q&A channel? Don't see any.
No, I don't see any in there. I think a lot of what you were presenting was information. But if anybody does have any questions, go ahead and feel free to post them, please, in the Q&A channel. That was well done, though. Thanks. That was an awesome overview. I think once we get to phase 3, we should start to open the channel here for voice questions. I know we've kept it so that the questions only can be posted in the Q&A channel, so we could get a complex protocol like this communicated. But I think we're probably going to want to open it up for voice questions here sometime in the next few AMAs. We've had some good people that have joined us regularly, and I'm sure they may want to ask questions verbally as opposed to writing them into the chat. So.
Yes, Rika, will do that in the future AMS. Would you like to add anything, Asrika?
No, I mean, I think you covered it. So that was well done. I don't have anything to add. Actually, that's not true. There was one thing that was crossing my mind, and now maybe I'll just mention it real quick. And that is when you were talking about some of the other protocols and the fact that there's a need for claims adjusters, and the fact that there's significant terms and conditions, and the fact that the way that their capital is allocated in such a way that it makes it very hard, all of those things, for them to be able to chase after a parametric policy. And I want to be really clear, all those protocols you covered are actually really good protocols, great teams, and I definitely want to make sure that we call that out. They've done some amazing work. The space right now that we're focused on is parametric, and one of the gaps we saw in the designs was around the ability to be able to provide parametric insurance. The challenge with parametric insurance is that there really aren't. There's a set contract for which you'll receive a set amount of funds. And there's no way in a true parametric contract for the carrier to get out of that. At least there shouldn't be, right? I mean, the reason why I'd pay for it would be because I'm going to receive a payout guaranteed. And so what we've been trying to design for is the ability for, first of all, people to get out if they want to, so it's not an expense. It actually can be viewed as an investment in certain cultures where people do not adopt insurance. But secondly, we wanted to make sure that there was a way for true parametric insurance to be offered where people are guaranteed to be covered in the event that it occurs. And one of the things you didn't cover, Mindusara, but is part of our design is that the types of events that we're looking to have parametric insurance for are those that occur frequently. That way, they are guaranteed to occur, and they're guaranteed to occur multiple times a year. And that there's no truer test of parametric insurance than to be insuring events that are guaranteed to occur multiple times a year. And I think this is part of what makes the protocol unique is that we're actually making that kind of notion a part of the protocol design where there's frequent events that occur. I think that's even more unique. Parametric's one thing; it's even more unique to be guaranteeing events and that they occur frequently. So, hard to do that with the other protocol designs. That was the one thing that crossed my mind, but that's all I had. I'm not sure if anybody else on the team has thoughts you want to share. Got a lot of quiet folks today. So.
Yeah, they are. And I want to use this opportunity to call out to the community to participate heavily on phase 2 launch, which is going to launch on September 19th. So that is when our bonding will launch. So we expect your continuous support for us to move forward. Yeah, and if there are any other questions, please feel free to post in Q&A. We'll be happy to answer. Thank you, everyone, for your time. Thanks all.
Yeah, thank you.
Thank you.